everyone. For my annual report project, I chose Palantir Technologies Incorporated. The following presentation will go over the following 10 sections. Section 1, Company Information. The name is Palantir Technologies Incorporated. Information about the company. They are an information technology sector, software infrastructure / application software industry that specializes in AI. The nature of the company's business is to build and sell data integration, analytics, and artificial intelligence software platforms for many large government and commercial organizations. Its tools help customers combine data from many systems, analyze it, and support real-time, AI-assisted decision-making in areas like defense, intelligence, healthcare, manufacturing, and finance. They are headquartered at 1200 17th Street, floor 15th, Denver, Colorado. These are their main products and services: Gotham, Foundry, Apollo, and AIP. Gotham focuses on data integration and analytics platform primarily used for defense, intelligence, and law enforcement agencies. Foundry is a data operating system for commercial and government customers, primarily used for integrating and analyzing enterprise data. Apollo is a software delivery and operations platform that manages deployment and updates of Palantir and customer software in any environment. And AIP connects large language models with other AI to enterprise data and operations inside Gotham and Foundry. They are quite a large operation. They operate in the United States, Canada, UK, France, Germany, the Netherlands, Italy, Israel, United Arab Emirates, Australia, and New Zealand. Their 2024 approximate revenue was $2.87 billion. The chairman of the board is Peter Thiel, and their chief executive officer is Alexander Karp. Palantir is traded on the Nasdaq Global Select Market. Their ticker symbol is PLTR. Their recent closing price on November 25th, 2025 was $163.55. Their 52-week low was $63.40 per share, and their 52-week high was $207.52 per share. Important note, all numerical figures are pulled directly from the 2024 Palantir Form 10-K, and unless explicitly stated, are in thousands. Section 2, Annual Reports Overview and Auditors. In their 2024 Form 10-K, there is no separate chairman's or CEO letters. Instead, management communicates the company's performance and outlook through Item 7, Management's Discussions and Analysis of Financial Conditions and Results of Operations, or the MD&A. In this section, management states that Palantir generated about $2.9 billion of revenue for 2024 and remained profitable under US GAAP. They emphasize that growth came from both government and commercial customers, with especially strong momentum in the United States and continued expansion internationally. Management also notes that a relatively small number of large customers still account for a meaningful portion of revenue, which is an ongoing risk that the company monitors. Item 7 also stresses Palantir's strategic focus on its four main platforms: Gotham, Foundry, Apollo, and the newer artificial intelligence platform. Management explains that AIP, which connects large language models and other AI tools to customer data, has become a major driver of interest in new deployments. At the same time, the company points out key risks and uncertainties such as macroeconomic conditions, government budget cycles, competition, and the need to keep heavily investing in research and development and sales. Overall, the section presents Palantir as a company that is growing, profitable, and heavily invested in AI, but also potentially exposed to customer concentration, government, and economic risks. Management and auditor reports. The independent audit reports are located in Item 8, Financial Statements and Supplementary Data, under the heading Report of Independent Registered Public Accounting Firm. There are two Ernst & Young LLP reports there, a report on financial statements and a separate report on giving an opinion on internal controls over financial reporting. Palantir's management is responsible for preparing the financial statements and for their integrity. Palantir maintains a system of internal controls to provide assurance that its financial reporting is reliable, transactions are properly recorded, and the financial statements are prepared in compliance with GAAP. These controls are in place to prevent and detect errors or fraud. The auditor's responsibility is to plan and perform the audit in accordance with PCAOB standards, and to express an opinion on whether Palantir's financial statements are fairly presented in all material aspects. An audit is an independent examination that includes risk assessment, testing evidence, evaluation of accounting policies, estimates, and presentation in order to obtain reasonable assurance that the financial statements are free of material misstatement. In Palantir's audit, the auditor issues an unqualified opinion, stating that Palantir's financial statements present fairly in all material aspects the company's financial position, results of operation and cash flows for the period presented in compliance with U.S. generally accepted accounting principles. Section 3. The balance sheet. Note that all amounts are from the consolidated balance sheets as of December 31st, 2024 and 2023 and are in thousands. In 2024, their assets totaled around $6.3 million, their liabilities $1.2 million, and their equity $5 million. In 2023, their assets totaled around $4.5 million, liabilities $1 million, and equity $3.5 million. Their 2024 current ratio was around 5.96, and in 2023, it was around 5.55. The current ratio measures a company's short-term liquidity. It shows how many dollars of current assets the company has for each dollar of current liabilities. Looking at the data, Palantir has about $5.96 of current assets for every $1 of current liabilities in 2024, and about $5.55 for every $1 in 2023. A ratio higher than 1 means that a company appears to be able to pay its short-term obligations as they become due, and a ratio below 1 can indicate that a company may have liquidity problems. 5.96 is a very healthy current ratio, however, it may indicate inefficient capital use. Further analysis of the common size balance sheet. Palantir's most significant investments are in highly liquid assets, mainly marketable securities and cash equivalents. These two categories make up a little over 80% of total assets. Palantir is financed primarily with equity. Total liabilities are only about 20% of total assets, and total equity represents about 80% of total assets in both years. Palantir's debt and other obligations are mostly short-term liabilities. About 80% of its liabilities are current, due within 1 year. There are a few noticeable changes between 2023 and 2024. Cash and cash equivalents increased significantly as a percentage of total assets from about 18.4% to about 33.1%, while marketable securities decreased as a percentage of total assets from about 62.9% to about 49.4%. This suggests that Palantir moved some resources from investments into cash to increase liquidity. On the liability side, accrued liabilities increased as a percentage of total assets, indicating higher accrued payroll, taxes, or other obligations. Current deferred revenue and current operating lease liabilities decreased slightly as a percentage of total assets, which may suggest there were new contracts and lease obligations. Overall, the changes show that the company increased its cash on hand and reduced securities. Liabilities did not have any large changes. Current assets composition. A larger share of current assets is now cash and cash equivalents in 2024 compared to 2023. Marketable securities are still the largest asset account, but they represent a smaller percentage of total assets than in the prior year. There are no massive changes to the composition of current liabilities, but there are a few things to note. Accrued liabilities now make up a bigger share of current liabilities and total assets, and current deferred revenue and current customer deposits decreased slightly as a share of total assets. The mix of current liabilities shifted somewhat towards accrued items, but total current liabilities as a percentage of total assets did not change dramatically. Palantir's debt-paying ability appears to be very strong based on the balance sheet and ratios. Its current ratio is very high, about 5.96 in 2024, which shows the company has many times more current assets than current liabilities. And the balance sheet shows the company's total liabilities are less than 1/5 of its total assets. A large portion of its current assets are in cash and short-term securities, which are liquid and low risk. Overall, this suggests that Palantir is in a very good position to pay its debts both in the short term and the long term. Section 4, the income statement. Gross profit rate is found by dividing gross profit by revenue. In 2024, the gross profit rate was 80.2%. In 2023, it was 80.6%. In 2022, it was 78.6%. Operating expenses to sales is found by dividing total operating expenses by revenue. In 2024, it was 69.4%. In 2023, it was 75.2%. And in 2022, it was 87%. Profit margin is found by dividing net income by revenue. In 2024, it was 16.3%. In 2023, it was 9.8%. And in 2022, it was negative 19.5%. Finally, return on assets is found by dividing net income by average total assets. In 2024, it was 8.6%. In 2023, it was 5.4%. And in 2022, it was negative 11.1%. We can get more information for decision making by looking at the common size income statement. Total revenue increased every year from about $1.9 billion in 2022 to $2.2 billion in 2023 and $2.9 billion in 2024. Revenue rose about 17% from 2022 to 2023 and almost 29% from 2023 to 2024, showing strong growth in total revenue year over year. Gross profit also improved by 2% from 2022 to 2023, but went down slightly by 0.4% from 2023 to 2024. This means Palantir is keeping a very high portion of each revenue dollar after cost of revenue, and it has maintained that strong margin over the 3 years. The ratio of operating expenses to operating revenues was 87% in 2022, 75.2% in 2023, and 69.4% in 2024. The ratio is decreasing over the 3-year period, as expressed in Item 7 of Palantir's 10K. The company is still spending a lot on sales and marketing, research and development, and general and administrative costs, but these expenses are growing slower than revenue. The ratio going down over the 3 years shows positive growth for the company. There are some shifts on individual revenue and expense items that should be discussed. Sales and marketing expenses dropped almost 6% from 36.9% in 2022 to 31% in 2024. This suggests that the company is able to generate more revenue without having to increase sales and marketing at the same rate. General and administrative expenses went down nearly 11% from 31.3% in 2022 to 20.7% in 2024. This is a large improvement and suggests that Palantir is managing administrative costs more efficiently. R&D costs stayed relatively similar across the 3 years, but went down as a percentage of revenue, suggesting that it remains a large investment but is slowly shrinking as a share of revenue. Other expenses, net, represented a significant loss in 2022, negative 11.6% of revenue. This number would improve in 2024, representing only negative 0.6% in 2024. This suggests that some of the one-time losses in 2022 did not repeat at the same scale in later years, which helped improve overall profitability. Income from operations and interest income also saw steady improvements from 2022 to 2024. There was a trend in strong improvement in both operating income as a percentage of revenue and net income as a percentage of revenue. Both went from negative percentages to positive percentages from 2022 to 2024. Palantir went from a significant loss in 2022 to solid profitability in 2023 and 2024. Both operating income and net income improved each year, reflecting higher revenue and lower operating expenses as a percentage of revenue. These changes are generally positive for the company. Revenue is growing at a faster rate every year, gross margin is high and stable, and operating expenses are becoming a smaller percentage of revenue, showing that Palantir is gaining scale and using its resources more efficiently. The shift from a double-digit negative net margin in 2022 to a double-digit positive net margin in 2024 suggests that the company has shifted from a period of initial investment and losses into a more profitable phase. Section 5. Current assets and receivables. Gross accounts receivables and net accounts receivables was the same in 2024, but differed by $10.5 million in 2023. This is because the allowance for credit losses was deemed immaterial in 2024, but about $10.5 million, or 2.8% of gross AR in 2023. Palantir does not report any inventory line. This makes sense as Palantir is a software and services company, not a manufacturer or retailer that holds physical inventory. Palantir also does not use the label cost of goods sold. Instead, its income statement uses cost of revenue, which should be the equivalent for a software business. In 2024, it was $565,990. In 2023, $431,105. In 2022, $408,549. The average net receivables in 2024 was $469,916, and the receivables turnover was around 6.1 times. The average collection period was around 59.8 days. Since Palantir does not have inventory, they do not report an inventory costing method. Also, inventory turnover is not applicable, and average days inventory is not applicable. Receivables turnover ratio shows how many times during the year the company collects its average accounts receivable balance. A higher number means receivables are collected faster, which is usually a good sign for cash flow, and a lower number means receivables take longer to collect. Average collection period converts receivables turnovers into days and shows the average number of days it takes a company to collect cash from customers after a sale. It can help companies evaluate how quickly they turn credit sales into cash. Inventory turnover ratio shows how many times the inventory is sold and replaced during the year, which helps evaluate how efficiently the inventory is being managed. For Palantir, it's not meaningful because the company does not carry any inventory. Average days inventory held shows the average number of days items stay in inventory before being sold. It is another way to measure how quickly inventory moves through the business, but again, this is not meaningful to Palantir because they do not carry any inventory. Palantir's customers are mainly large government agencies and commercial enterprises that purchase through multi-year contracts. These types of customers usually have longer billing and payment cycles than small retail customers, but they are also generally low credit risk. With a receivables turnover of about 6.1 times and an average collection period of 60 days, Palantir is collecting receivables in about 2 months on average, a reasonable time frame when dealing with governments and enterprise contracts. The allowance for credit losses being immaterial in 2024 and only about 2.8% of gross receivables in 2023 suggests that bad debts have been low relative to the amount billed. Altogether, this indicates that Palantir's receivables collection is strong. Palantir does not manufacture or sell physical products and does not report any inventory on its balance sheet. Therefore, there is no inventory management data to evaluate. Palantir records property and equipment at cost and depreciates these assets using the straight-line method over their estimated useful lives and respective assets, which are generally 3 years. Taken directly from the Form 10-K, Leasehold improvements are capitalized and amortized using the straight-line method over the shorter of the remaining lease term or the estimated useful life, generally which is 5 years. Maintenance and repairs that do not improve or extend the useful lives of the assets are expensed when incurred. Upon sale or retirement of assets, the cost and related accumulated depreciation and amortization are derecognized from the consolidated balance sheets, and any resulting gain or loss is recorded in the consolidated statements of operations in the period realized. Palantir reports finite-lived intangible assets that consist mainly of customer relationships, reacquired rights, and backlog. As of December 31st, 2024, the net carrying amount of intangible assets was $18,058,000. The company does not report any goodwill on the balance sheet. In 2024, the average useful life of plant assets was around 6.6 years. The average age of plant assets was around 5.2 years. Asset turnover in 2022 was around 5.57, in 2023 around 0.56, and in 2024 0.53. The return on assets in 2022 was negative 11.1%, 5.4% in 2023, and 8.6% in 2024. The asset turnover ratio shows how efficiently the company uses its total assets to generate revenue. A higher asset turnover rate means Palantir is earning more revenue per dollar of assets. Palantir's asset turnover is a little over 0.5 each year, which is typical for a company that holds lots of cash and securities and has relatively light physical assets. Return on assets measures how profitable the company is relative to the total assets it controls. It tells how many cents of profit are earned for each dollar of assets. Palantir's ROA improved from a negative value in 2022 to about 5.4 in 2023 and 8.6% in 2024, which indicates strong growing profitability and a better use of assets over time. The average useful life of plant assets is around 6.6 years, and the average age of plant assets is around 5.2 years. This means that, on average, Palantir's property and equipment are a little past the halfway point of their estimated useful lives. These assets are not brand new, but they still have some time before they reach the end of their useful life. This can suggest that Palantir has been investing into its infrastructure over time. However, the company may need to invest more in the future to replace or upgrade assets as they age. In 2024, Palantir's depreciation expense was $31,587,000, and in 2023 it was $33,354,000. For Palantir, the line depreciation and amortization increases operating cash flow by their respective amounts in 2024 and 2023. Depreciation is a non-cash expense that reduces net income but does not use cash, so it is added back into the operating section of the cash flow statement. For capital expenditures in 2024, it was $12,634,000, and in 2023, $15,114,000. In 2024, Palantir's capital expenditure ratio was 91.3, and in 2023, it was around 47.1. Palantir's capital expenditure ratio is extremely high in both these years. A ratio of 2 would mean the company could have doubled its current level of capital spending without outside financing. These numbers seem abnormally high and are caused by multiple factors. Palantir owns a relatively small amount of property and equipment when compared to the revenue that their operating activities generate. They are a relatively asset-light, software-focused business, where the main investments are in people and R&D rather than in large physical plants and machinery. This helps explain why their capital expenditure ratio is so high and shows that Palantir's ability to finance capital spending through their operations appears to be very strong. Section 7. Liabilities and Debt-Paying Ability. Palantir's current liabilities in 2024 totaled 996,018,000 and 746,018,000 in 2023. Their long-term liabilities totaled 250,459,000 in 2024 and 215,442,000 in 2023. In Note 8, Commitments and Contingencies, Palantir describes several important commitments and contingencies. Palantir has non-cancelable purchase commitments with third-party cloud hosting and infrastructure providers. A table in the notes show total remaining purchase commitments of a little over $2 billion over several years. The company also has long-term lease agreements for office space and related facilities totaling a little over $220 million, offset partially by expected sublease income. Palantir is also involved in various legal matters and regulatory proceedings in the normal course of business. The company states that it records a liability when a loss is probable and reasonably estimable, and that management does not expect these matters individually or in the aggregate to have a material adverse effect on its financial position. Palantir's current ratio in 2024 was around 5.96 and around 5.55 in 2023. Its acid test ratio in 2024 was around 5.83 and around 5.41 in 2023. Its debt to total asset ratio in 2024 was around 0.197 and around 0.213 in 2023. The current ratio measures a company's short-term liquidity. It shows how many dollars of current assets the company has for each dollar of current liabilities. Looking at the data, Palantir has around $5.96 of current assets for every $1 of current liabilities in 2024, and around $5.55 for every $1 in 2023. A ratio higher than 1 means that a company appears to be able to pay its short-term obligations as they become due, and a ratio below 1 can indicate that the company may have liquidity problems. 5.96 is a very healthy current ratio. The acid test ratio focuses on the most liquid assets by excluding items like prepaid expenses. It shows the company's ability to cover current liabilities using cash, marketable securities, and receivables without having to sell less liquid assets. Palantir's ratios, around 5.83 in 2024 and 5.41 in 2023, show that even after removing prepaids and other less liquid items, the company still has more than 5 times its current liabilities in very liquid assets. The debt to total asset ratio measures how much of a company's assets are financed by liabilities rather than with equity. Lower values indicate a more conservative capital structure and less financial risk. Palantir's debt to total asset ratio is around 0.2 in 2024 and 0.21 in 2023, which means roughly 20% of assets are financed with liabilities and 80% with equity. Palantir's debt-paying ability appears to be very strong. The current ratio and quick ratio are both above 5 in 2023 and 2024, which means the company has several dollars of liquid assets for every dollar of current liabilities. The debt to total asset ratio is around 20%, showing that Palantir relies much more on equity than on debt to finance its assets. In addition, Palantir has a large undrawn revolving credit facility of $500 million that matures in 2027. The 10-K explains that this credit line remains completely undrawn and is available to fund working capital or other needs as required. Palantir's filings also indicate that it does not use off-balance sheet financing arrangements. Its main commitments are ordinary items like leases, cloud infrastructure purchase agreements, and legal contingencies, which are disclosed in the notes. Section 8, Stockholders' Equity and Market Ratios. All these figures are from the consolidated balance sheets as of December 31st, 2024 and 2023, and are in thousands. There are 20 million Class A common stocks authorized, 2.7 million Class B common stocks authorized, and 1,005 Class F common stocks authorized. In 2024, around 2.2 million shares were issued and outstanding, and in 2023, around 2.1 million were issued and outstanding. For Class B common stock, in 2024, around 95,401 shares were issued and outstanding, and 102,141 shares were issued and outstanding in 2023. For Class F, the amount authorized, issued, and outstanding is the same at 1,005 shares for both December 31st, 2024 and 2023. Palantir's charter authorizes preferred stock, but the company has no preferred stock issued or outstanding as of December 31st, 2024. Besides contributed capital, additional paid-in capital, and retained earnings, Palantir reports the following equity-related accounts in the stockholder equity section on page 84 to 85. That being accumulated and other comprehensive income, loss net at 5,611 in 2024 and 801 in 2023, accumulated deficit at 5.187 million in 2024 and 5.649 million in 2023. On the balance sheet, there is a separate line of non-controlling interest, which is not a part of Palantir's stockholder equity, but is included in total equity. They both total, in 2024, it totaled 91,132, and in 2023, 85,404. Palantir states in its 10-K that it has never declared or paid cash dividends on common stock and does not expect to pay cash dividends in the foreseeable future. Since Palantir pays no dividends, the dividend yield is zero. Palantir's stock price at the end of 2024 was $75.63 per share and $17.17 per share at the end of 2023. Its basic earnings per share, or EPS, in 2024 was 21 cents per share, and in 2023 it was 10 cents per share. The price-earnings ratio in 2024 was around 360.1 and around 171.7 in 2023. The return on stockholders' equity, or ROE, in 2024 was around 10.9% and around 7% in 2023. The dividend payout ratio shows what percentage of net income is returned to shareholders as cash dividends. Since Palantir does not pay cash dividends, it has been able to reinvest all of its earnings back into the business instead of paying out dividends. Dividend yield measures the cash return an investor receives from dividends relative to the current stock price. Palantir's 0% dividend yield in both years tells investors that returns must come from share price appreciation rather than from dividend income. Earnings per share indicates how much profit is earned from each share of common stock. It helps compare profitability on a per-share basis across time or between companies. Palantir's EPS increased from 10 cents in 2023 to 21 cents in 2024, showing that profitability per share more than doubled year over year. Price-earnings ratio compares the stock market price to its earnings per share. It reflects how much investors are willing to pay for $1 of current earnings and can indicate expectations for future growth. Palantir's high price-earnings ratio suggests that the market is confident for future growth and that investors are willing to pay a premium for shares of the company. Return on common stockholders' equity, or ROE, measures how effectively the company uses shareholders' equity to generate a profit by showing the return the company is earning on the owner's invested capital. Palantir's ROE improved from about 7% in 2023 to about 10.9% in 2024, which indicates that that management is generating higher profits relative to the equity invested in the business. The issuance of common stock from the exercise of stock options totaled 745,396 in 2024 and 218,238 in 2023. In 2024, repurchases of common stock totaled around negative 64,196, and in 2023, there was no repurchase line, so the amount is zero. For both years, no cash dividends were paid out. In 2024, net cash provided by financing activities increased by $463,364, and in 2023 by $218,839. In both years, financing activities increased Palantir's cash balances. Putting all the ratios together, Palantir looks like a growth-oriented, high-valuation stock, but it is not perfect. It comes with risks. The earnings per share has improved from 10 cents in 2023 to 21 cents in 2024, and the ROE increased from 7% to 10.9% in the same period, showing that profitability and returns on equity are trending in a positive direction. However, its extremely high price-earnings ratio means the market is paying a high price for each dollar of earnings. High price-earning stocks can offer big upsides if the growth can continue, but can leave you in a hole should the company fail to meet expectations. The stock also does not pay dividends, which does not make it a good choice for investors who need regular dividend income. Overall, Palantir stock looks more attractive for investors who are comfortable with volatility and are focused on long-term gains rather than dividend income. Total cash, cash equivalents, and restricted cash at December 31st, 2024 is around $2.1 million. In Note 2, Palantir reconciles this total, with cash and cash equivalents at around $2.1 million, restricted cash, current, at $7,704, and restricted cash, non-current, at $13,708. These add to $2,119,936, which matches the total in the cash flow statement. For 2024, net cash used in investing activities is negative $340,655,000, which is an outflow of cash. Purchase of marketable securities at $5,395,913 was the largest cash flow item from investing activities and is a cash outflow. For 2024, net cash provided by financing activities is $463,364, which is an inflow of cash. Proceeds from the exercise of common stock options totaling $745,396 was the largest cash flow item in the financing section and is a cash inflow. For 2024, net cash provided by operating activities is $1,153,865, which is an inflow of cash. In 2024, the net income of the whole company was $462,190. In 2023, it was $209,825, and in 2022, it was negative $373,705, which is a net loss. Palantir uses the indirect method for reporting net cash flows from operating activities. You can tell because the operating section starts with net income and then lists adjustments to reconcile net income to net cash provided by operating activities, including non-cash items such as depreciation and stock-based compensation, and changes in operating assets and liabilities. The net cash flow from operating activities in 2024 was around $1.2 million. In 2023, it was $712,183, and in 2022, it was $223,737. For free cash flow in 2024, it was around $1.14 million. In 2023, $697,069. In 2022, $183,710. The current cash debt coverage ratio in 2024 was around 1.32. The cash debt coverage in 2024 was around 1.05, and the cash return on sales in 2023 was around 32% and around 40.3% in 2024. Free cash flow shows how much cash is left over after the company has paid for its capital expenditures and any cash dividends. Palantir's rising free cash flow indicates that it is generating more cash than it needs for its relatively cheap capital spending, which gives management more flexibility for future investment decisions. Current cash debt coverage ratio compares cash provided by operating activities to average current liabilities. It indicates the company's ability to cover current liabilities from operating cash flows during the year, instead of just looking at year-end balances. Palantir's ratio of about 1.32 suggests strong short-term cash coverage of its current obligations. Cash debt coverage ratio compares cash debt coverage ratio compares cash provided by operating activities to average total liabilities. It measures the company's ability to cover all of its liabilities, both current and long-term, with its yearly operating cash flow. Palantir's ratio of about 1.05 indicates that a single year of operating cash flow is slightly greater than its average total liabilities. Cash return on sales ratio shows how much operating cash the company generates from each dollar of sales. A higher ratio means that a larger share of revenue turns into cash from operations, which is usually a good sign. Palantir's increase from about 32% to 40.3% means it is converting a larger share of its sales into cash. Liquidity. Palantir's current cash debt coverage ratio of about 1.32 shows that cash from operations in 2024 was more than enough to cover average current liabilities. Combined with very high current and quick ratios from earlier sections on large cash and marketable securities positions, this indicates strong short-term liquidity. The company appears well-positioned to meet its upcoming obligations using existing cash and new cash generated from operations. Solvency. The cash debt coverage ratio of about 1.05 means that 2024 operating cash flow is slightly greater than average total liabilities, together with the fact that total liabilities are only about 20% of total assets and equity represents about 80% of the capital structure. The cash flow data supports the view that Palantir is conservatively financed and has strong long-term solvency. The company is not heavily reliant on debt and could, in theory, repay its entire liability base in roughly 1 year of current operating cash flow. Profitability and cash generation. Net income turned positive in 2023 and increased to $462,190 in 2024, while operating cash flow reached $1,153,865,000. The cash return on sales ratio rising from about 32% to 40.3% indicates that profitability is increasingly backed by strong cash generation. Positive and growing free cash flow suggests that Palantir can fund its capital spending and still have enough cash left for strategic uses. When looking at all these factors together, these cash flow ratios indicate that Palantir has very strong liquidity, excellent solvency, and improving profitability. Section 10. Overall evaluation of Palantir. After reviewing the 2024 Form 10-K and completing the sections in this project, I will summarize Palantir's performance, financial position, cash flows, and key ratios, then give my recommendation on whether a friend should invest. Palantir's revenue has increased each year, from about $1.9 billion in 2022 to $2.2 billion in 2023, and to about $2.9 billion in 2024. Gross profit margins stayed very high at around 79 to 81%, which means the company keeps a large portion of each revenue dollar after cost of revenue. At the same time, total operating expenses as a percentage of revenue declined from about 87% in 2022 to 69.4% in 2024. As a result, Palantir moved from a net loss in 2022 to a positive net income in 2023 and an even stronger profit in 2024. Overall, the income statement shows rising sales, stable high gross margins, and better control over operating costs. The balance sheet shows that Palantir is an asset-light software company. It does not report any inventory and has a relatively small amount of property and equipment when compared to its total assets. Most of its assets are in cash, cash equivalents, and marketable securities. The company is financed mainly by equity rather than debt. Total liabilities are about 20% of total assets, and stockholder equity represents about 80%. The liabilities are current items such as accrued liabilities, deferred revenue, lease liabilities, not long-term borrowings. Palantir's cash flows are a major strength. Net cash provided by operating activities increased from about $224 million in 2022 to $712 million in 2023 and about $1.15 billion in 2024. Capital expenditures for property and equipment are relatively small, which leads to strong and growing free cash flow. Free cash flow was about $184 million in 2022 and grew to about $1.14 billion in 2024. The company pays no cash dividends, so all this free cash can be used to support growth, build cash reserves, repurchase shares, or make further investments into the company. Liquidity appears very strong. The current ratio is about 5.96 in 2024, and the quick ratio is about 5.83, which means the company has more than $5 of liquid assets for every $1 of current liabilities. The current cash debt coverage of about 1.32 indicates that 1 year of operating cash flow is more than enough to cover average current liabilities. Solvency is also strong. The debt to total asset ratio is around 0.2, and the cash debt coverage ratio is about 1.05, which means that operating cash flow for 2024 is roughly equal to or slightly greater than average total liabilities. Profitability ratios are also trending in the right direction. Return on assets improved from a negative 11.1% in 2022 to 5.4% in 2023 and 8.6% in 2024. Return on common equity increased from about 7% in 2023 to about 10.9% in 2024. These levels are moderate, but clearly improving and are supported by strong operating cash flow. Management also appears to become more efficient, as sales and marketing and general and administrative expenses have declined as a percentage of revenue over time. Palantir pays no cash dividends, which means investors rely entirely on share price appreciation for returns. At the same time, Palantir's stock trades at a very high price-earnings ratio based on recent results. High PE ratio signals that investors expect strong future growth and are willing to pay a premium for the stock, but they also increase the risk that the stock price could drop if the company underperforms. Based on my analysis in this project, I believe Palantir is financially strong and still growing. If my friend is more conservative or an investor who wants more steady dividends and low volatility, I would not recommend Palantir. For a friend who is more comfortable with risk and is looking for a long-term growth investment in data and AI software, my recommendation would be to buy Palantir stock as a part of a diversified portfolio. Thank you for listening to my annual report project.